Bank of England, I know, is sort of a non-event unless you think it's a big deal. Let's move on. The German low yields, what are the ramifications of that for the European financial system?
Well, it's certainly a loosening of credit if you think about it, Tom, and the same for treasuries as well. You're doing the monetary policy side of things for you in the bond market, but it's not so much the ramifications, it's what the bond market is telling us, Tom. And it's telling us three things. It's telling us that inflation is going nowhere, growth is going nowhere, and rates are going nowhere. 2 years ago in Europe, if you saw low rates, you thought it was a good thing. Low rates right now is not a good thing. It spells out a pretty bleak economic outlook here in Europe, Tom.
Yeah, you look at the bleak outlook here. Mario Draghi will speak later this morning. I believe it's 11 a.m. our time. What would you expect to hear of Mr. Draghi? Does he just get down on his knees and say, "Oh, Merkel, help me"?
No, maybe he gets down on his knees and says, "Oh, Janet, help me," because the really interesting development that came out of the Federal Reserve minutes yesterday was the fact that there was this united front against a strong US dollar. Well, I'm going to do the talking for Mr. Draghi. I imagine he wants a strong dollar. He wants a weak euro. What we're seeing now isn't so much a currency war. It's a fight for inflation. And, Tom, the easiest way to do it, a weaker currency.
Well, you see a weaker currency, and David Malpass, Adam Johnson, saying yesterday with Encima Global that the dollar's linked to gold. Gold up $25 this morning.
That is quite a move, especially since it broke 1,200, which was the...
Yeah, exactly.
So it looks like a head fake. Gina, here's a question. In a world where over in Europe we see negative 2-year rates right now in Germany, Switzerland, and the Netherlands, does that mean you bring the money back and you just keep it here in the U.S.? Too hard?
To a large extent, yeah. And this is actually quite typical, although rates are extremely low. It's very typical to see that as the Fed is shifting in advance of everyone.
I want to interrupt here and be rude. We just have a headline across the Bloomberg. John, you nailed this a week ago. Germany's 10-year bond yield drops to record low of 0.865%. Gina Martin Adams, what does that mean for U.S. investors? I'm sorry, we're linked to that headline, aren't we?
I mean, it does mean that there's deflationary risk growing around the world. This is something we've contended with at the end of every QE program, mind you. So go back 2010, 2011, now. Every single time as the Fed starts to try to get away from QE, a crisis seems to emerge in Europe.
You did a Mark Faber imitation earlier. Adam, can you do a Rubini imitation? QE1, Q...
Yes, Tom. There was a QE1, there was a QE2, the QE forever. That is the problem. We have to have the QE.
Okay, so there it is, John Ferro. Dr. Rubini this morning talking about QE6. John Ferro, seriously, is that what we're seeing right now? Is a joint QE7?
I don't know about that. What I see here from the other side of the pond is a Federal Reserve that's scared of its own shadow, scared to even change the language in the statement at the FOMC because they're scared of the reaction in the market, conditioned by their experience of 2013 when Treasury yields went higher by 100 basis points. Tom, that isn't good news. And when the Federal Reserve comes out and says we're concerned about growth in the Eurozone and equity markets rally off the back of it because you get this low for longer scenario, let's get real about the real man on the street. 99% of this people on this planet won't care about low rates for longer and it's good for equity markets. They'll see a concern about growth, a concern about inflation, and that is not good news. Bad news is bad news, full stop.
Hey, John, European Central Bank President Mario Draghi speaking at 11 o'clock New York time today. That's in about, I don't know, what is that, 4 hours. What are we going to hear from him?
Well, I've talked a little bit about the currency side of things, so certainly he's got a fight on his hands whilst the G20 starts. On the other side of things, look, he's facing more and more pressure to do more and more, but I think the ECB is getting to the end of the road while people are calling for more sovereign quantitative easing. Tom, you've got bond yields in front of you. Look at German bond yields, look at Spanish bond yields, look at Italian bond yields, and you guys tell me what QE is going to do for Europe with yields already collapsing.
You look at that policy tool is in effect, and Olivia goes to the IMF meetings in the greater international economics. We're having a 1930s conversation.
Yeah, the conversation, as Christine Lagarde told you, is that we're approaching the new mediocre. John, I just want to ask you about the Bank of England minutes out this morning. What do these bund yields mean for Mark Carney? He's still keeping rates steady at 0.5%.
Well, Mark Carney's certainly got to worry about the growth dynamic in the Eurozone. If the Fed is worried about growth in Europe, the Bank of England is definitely worried about it. No decision today, unchanged. I know that. October 22nd, big decision. The minutes. Look for the vote, look for the concerns.